Hey everybody, this is Jose Blasco. We are about to get started. Just a moment. A quick sound check, as always. Before we start the session, we normally say hello in the chat box, isn't it? It's nice, and it tells me you hear me. So that's the plan. And by the way, I'm noticing I am using the wrong background for the session. Let me change that very quickly. While you guys type hello on the chat box, so we can have like a proper, beautiful blue background, something a bit nicer. Thank you, guys. Thank you so much, Joe, Mark. Wonderful. Yeah, pretty cool. Ready to get started here in just a few seconds. Very good. That's it. Time to go. Wonderful. Welcome to the session, everybody. Today is September 1st, 2022. My name is Jose Blasco. This is Options Trading Live. We're going to be looking at the options markets. We're going to be looking at opportunities. We're going to be looking at market analysis and all of the above. As we're starting the session, I am looking right and left multiple times because I was glad to speak in past. I was having a little bit of a problem to log in one of the platforms with the TOS. It was giving me some technical difficulties today, but it seems that I will be able to do it. So that's great. Sorry for looking right and left. In any case, as we get started, as always, I wanted to highlight our financial disclaimer. Please read it carefully. This is important information. It is fairly short, as I always say, and therefore I'm counting on you all to read it completely. Please do not skip it. It's important. Thank you so much. Good to see you all, Jeff, Joe, Mark, everyone. If you're watching this recorded, hello to you too. And for the ones of you that are new, the structure of the sessions is normally looking at the markets. Then we review trades that we may have that may imply management, and indeed that will be the case today. And from there, we move into looking for new market opportunities. Okay, so lots to discuss today. I guess we all know the market has been violent, not a joke, and it's time to jump into those charts and begin our market analysis. Okay, so closing this so we can move into top. Okay, very good, perfect. Okay, so let's begin with analyzing the VIX, and you will see how, not that one. Okay, yeah, VIX, here we go. So we are looking at the VIX. Notice how the VIX is now currently trading at 27, right? So if you recall, last week it was more or less in the middle. It was, somewhere in here in the, actually, it was a bit lower, isn't it? Right, somewhere here in the 20 area, more or less. And is now trading at 27. And why is that? Well, it's quite obvious. The S&P has been falling very, very aggressively. Obviously, that scares everybody. When people are scared, they start buying options like there is no tomorrow, and therefore the implied volatility of the options skyrockets. And we can see that in the VIX, being the VIX, the average index that represents the implied volatility of the 500 stocks that make up for the S&P 500 index itself. So looking at the S&P 500 itself, we can see how the market keeps falling. Today, the market is down by 1.20 something percent. It's all red UFOs. In the 55-minute time frame, we don't see any green UFO. In a little bit larger time frames, of course, there are UFOs. So if we move to a daily time frame, there is a green UFO down there. If we look at a 2-day time frame, there is a green UFO down there. 3-day time frame, it looks like we may be getting into some green UFO now. Okay, so obviously now, by the way, the 3-day time frame UFOs for the S&P is not the best in the world, 48%, but happens to be a UFO. And the thing is that when we look at the market climate, we are now dealing with a climate that has been running in a confirmed fashion to the downside for 4 candles, where statistics suggest 3 is a normal thing to happen. So from a statistical point of view, we may start reaching exhaustion. And from an extension point of view, 2.20 is indeed like almost double 1.14, which is already a 2 standard deviation of max distance. So it's like the market is moving, reaching levels in ATR multiples of around 4 standard deviations, which from a probability standpoint is extremely unlikely. And another way to say that from a trader point of view is statistically unsustainable. Okay, so given the fact that we are entering a green UFO, so the expectation will be to see the market turn and begin traveling to the upside. Okay, that would be the expectation. Now, is that likely going to happen or not? Well, again, based on the autoclimate, yes. Of course, we will get a bit more confirmation and certainty that that's the case the moment we got green UFOs on the screen, also in the intraday timeframes. We don't see that yet. Why the intraday timeframes? Well, because we have a pretty fat green UFO on the 3-day time frame. Let's call it a larger time frame. So in other words, we expect on-field orders to be at those price points. But when are we going to have the proof of that? Well, we'll have the proof of that when the market either turns and goes like V-bottom type of movement, or when the market turns and starts moving up slowly, but on the way up, we now see green UFOs show up on the intraday timeframes. That basically means that you see on-field orders where you expect on-field orders to be, right? And that would certainly add a lot of probability in the favor of the markets going back up. So far, we haven't seen that. So we need to trade what it is, not what we think. It's like last week, if you recall. Let me make sure I give you the right date. So last week, Thursday was on the 25th, okay, of August. So the 25th, yeah, exactly, was here, okay? So the market was going higher on that day. I was pretty bullish on my comments. The only thing I said is the climate is still red. We need to wait for the climate to change to blue. It changed to blue, but it was unconfirmed. And the day it changed to blue, we got the gray line go above the blue line, which means sellers are coming into the market. And what a kind of end of the world type of move that we got as a continuation. So in other words, even last Thursday, where things really were looking like things were going to really become very bullish and very positive because the blue line was above the gray line, the climate was likely going to change. I remember having pretty positive comments on the market, but I also remember I said, we need to wait for the climate to change to do this safely, right? So same thing now in the opposite direction. So we got the blue line above the gray line by just a little bit, but it is, okay? So there are buyers in the market, and this is, by the way, a common situation to find. When the markets are falling sharp, very smart players want to buy the markets at a low price point. So, we got some buyers coming into the market. It's not like the market is crashing, like, for example, at the time where the market was crashing and clearly the gray line was above the blue. It's not the same market scenario. It's a market scenario where buyers are around. So that's good because the market is overextended. 212 is 4 standard deviations of 113. So, again, statistically unsustainable. But just like last week, not waiting for a thick blue dot to appear is basically speeding. And the risk of speeding is that you get a ticket. Okay, so we've got to be very careful here and trade safely. Non-directional trading was the approach when the market is in a situation where we don't have a permission to go ahead and go long or short. And when I say permission, I mean based on my rule set, which I'm very happy to share during the sessions, but I would totally understand as well that you guys have your own rule sets. Actually, that's what you should do. Have your own rule sets. Your rule sets may be based or inspired by mine, maybe variations, maybe totally different. There are many ways on how to trade, which are certainly valid as long as you stack odds in your favor, manage your risk, manage your emotions, those 3 components in place. There are many ways to be profitable in the market, but they all imply those 3 components, okay? So let's keep that in mind. So based on my rule set, this is exciting to get ready to shoot, but it's not time to shoot yet. By shooting, I mean going long, okay? We need a change of climate combined with the blue line being above the gray line, meaning buyers in the market that we spot in the derivative markets. And then we are talking, okay? This did not happen last week, almost, but it didn't. And this will happen or not in the future, we'll see. And if it happens, then time to go, okay? Questions about the market analysis, guys? If you have any question, let me know. The plan for me, given the fact that we are in a complete opposite picture compared to last week, but in the same situation compared to last week, meaning that no time to go long and it's too late to go short, okay? So because we're in that situation, so non-directional trading will be my approach based, again, on my set of rules. And because implied volatility this week is 27, certainly it's going to be iron condors. Last week I said, it's in the middle, it's not high, it's not low, we can do one or the other. This week, no. Implied volatility on the VIX is very, very high. So finding stocks that also have their own implied volatility high in line with the VIX implied volatility would maximize the probability of volatilities to drop and therefore collect very nice hefty premiums now that would then later on shrink as the VIX and the implied volatility of those stocks shrink as well. So we want that, and therefore today it's going to be an iron condor day when I get into looking for market opportunities. I would expect, by the way, some of those market opportunities to be found a bit more easily compared to last week, because we have a bit more juice in the market, given the fact that the VIX went up. So we should find more implied volatility available at this stage. Okay, so we'll take a look at that. Nasdaq just hit a daily UFO with the YM holding a daily UFO as well. Got you. Now, having said that, Joe, I'll make an extra comment about that. So if we look at the Dow, for example, the AI, actually in a daily time frame you mentioned, well, based on my settings, I don't see a UFO. And these may be because my settings may be different than yours when it comes to how I calibrate my UFOs. And by the way, I was expecting a lower number. I was going to point at the fact that the ETFs, many times they would have lower values compared to looking at the futures markets. Okay, so for example, if we look at the QQQ, which is the Nasdaq futures, the Nasdaq ETF, it's showing 53%. If we look at SPY or the Dow was 54, SPY is 54, so very similar values, which are better than many other times in the past as well, because of the market being very decisive and probabilities show a little better recently. But if you were to look at, for example, instead of S&P, you were to look at S&P futures on the daily time frame. Okay, I know what is this. Yeah, forget about that 34%. That's not correct. Okay, it's just because I am loading a delayed data feed, as you can see here on top, because I am using top for QC. So if you are doing that with top for TradeStation, you should have a much better number there. And here I can see the UFOs that you're talking about. So there is a green UFO on the futures markets, which certainly it's relevant. Okay, so again, odds are that we're going to see the market turn and go back higher because of the huge extension, buyers in the market that we spot on derivatives, blue line above the gray, right? And on top of that, we got UFOs on the 3-day time frames, UFOs on the futures markets. So we should see the market go up. But again, let's not get excited. Let's wait for a change of climate and then act. In the meantime, let's do non-directional trading and take advantage of the high premium that we find in the options markets. By the way, I'm realizing I forgot to turn off the ticker in the bottom part of the screen. You guys feel free to tell me in future sessions if you see me that I got distracted there and you'd like me to turn that off, okay? Yes, my calibration is 0.618, correct. Yeah. Cool. Okay, so let's go for it. Let's review our trades. We got 2 trades running. One is Nucor. Okay, Nucor, which is currently reporting around $73 of profit per contract. That's a double calendar. And the Iron Condor with Lennar Corporation is currently reporting negative $27.5, even though this Iron Condor, to be honest, should have been massaged since multiple days ago, and actually we should have acted on this Iron Condor, I believe it's a couple of times. So we're going to look at the chart and look at it. You know that since we only meet once per week, so I only have the opportunity to do it in front of you, and I mean, I don't want to do it by myself because, you know, what's the point? I want to do it in front of you, and therefore that puts me at a disadvantage, which I do not care, because I do this for you guys to learn so you can do it by yourself. But at the same time, for the ones of you who are in this trade live, and I would love to know if any of you is running this trade live in your account with paper money or real money. So did you act on Lennar Corporation? Please answer on the chat box, because later when I review it, I'll start with Nucor, but when I go back to Lennar, I would love to know, okay? So right click on Nucor. Let's load the race graph. I will close this and I will load Nucor so we can go and take a look at the chart. Okay, so here we go. So Nucor is a non-directional trade, is a double calendar where the basis of the trade is those purple lines where we own calls long and short at 150 and we own puts long and short at 125. This is the basically the construction of the double calendar. Okay, we started here on that date. Okay, so price went higher, then price went lower. So notice there was a time where we were fairly close to the purple line above. Now we are fairly close to the purple line below. So obviously we want to stay between the purple lines because this allows us to do most of the rolling. And the more the tweaks we do before we get to the expiration date, the better. Actually, the key really is not the expiration date, is the fact that earnings is happening before the expiration date, because that should rise implied volatility by a lot. Okay, now take a look at what's happening to the implied volatility of Nucor already. So if I look at the implied volatility, it's currently trading at 47. So since we entered the trade, we entered on that day, that was 8/4. So since 8/4, volatility was trading down here. Okay, and we got volatility now trading at 47. So we have gained profitability thanks to an increase in implied volatility. Now, this is probably the last time earnings were reported. Let's take a look. Okay, no, earnings were here. So notice that implied volatility may rally to 50 plus level. So there is a little bit of extra room for implied volatility to rally, but of course, with a very intense crash going down in the market, so that implied volatility has went up a lot. And the good and the bad of this trade at this moment in time is that we are very close to the bottom purple line. So if I roll my put, I'm going to get a lot of premium there. That's great. But the problem is if I roll my call now, I'm going to get very little. Okay, so because I'm very far from the call. The opposite happened when we were closed. When we were close to the upper purple line, that rolling the call paid nice, but rolling the put paid very little. Okay, so we are basically in the opposite situation. Okay, it should be a bit better because implied volatility went higher all the way to 47. So it should be a bit better. But again, if you were watching this trade in the prior days and you were consulting, you were checking on the option chain if there were distorted Greeks, or you get to see the call values to drop by a lot, which obviously when that's the case, the Greeks will get distorted. Even if you are like 4 or 5 days to expiration, with this very severe drop, pretty positive the calls got distorted Greeks. So you could have rolled sooner than today, Thursday, and got more from the calls because you would be further away from the expiration date, so you get more premium, and you will be closer to the upper line, so you get more premium. So again, I'm doing the roll at a disadvantage. Having done the roll in a prior day would have probably been better. Okay, but anyway, we're gonna do it today. That's the day when we are meeting, so we're gonna do it today. And in order to do it, I am copying the primary spread, so we're gonna do the roll. Okay, so again, the roll consists of taking the September 2 expiration dates that we are short, and moving them, rolling them to the next one, which is September 9. Okay. Before we do that, okay, the process is to look at the option chain. We look at those expiration dates, September 9 and tomorrow, September 2nd. We look at the only strikes we care about for this trade, which is the 125 and the 150. Okay. And if we start with the call side, so the 150 pays 14 cents. I'll start from above. The 150 pays maximum 6 cents. There is no bid. Therefore, there is no theta. Therefore, the Greeks are distorted. So we have to roll the calls. Problem, I'm going to have to pay 6 to get out. I'm going to get 14 to get in. So I get very, very, very little premium. Okay. Joe, good job, my friend. Mark, good job, my friend. You rolled it yesterday, so you got more than what I'm going to get today, and that's the way to do it, okay? So very well done. Very, very happy to see those proper actions that you guys do independently. Really love that, my friends. So, Nucor. Here is the call. If I create a rolling order, waiting for data, here we go. So that's going to pay me 4 cents, okay? Now, would I do it at this stage? No. Okay, so let's say that's the case. You could not trade the day before, whatever. and that's what you have, doesn't make sense. You're going to pay $2 in commissions. I'm just running it up, right? So let's say you pay $1 per contract, so you're going to pay $2 in commissions just to get 4. What's the point? It's kind of like a waste of time, because the most you would be able to make then is 2, where if you don't do anything and you just you don't do anything and you save $2 of commissions, it's kind of the same as you made 2, right? Nucor, NUE. Okay, NUE. Oh, Joe, you are talking about Lennar Corporation. Got you. Yeah, the call should have been rolled as well there. Okay, I'll talk about those later. So what do we do in cases like that? Well, in cases like that, I'm just gonna let it be. And the one thing I will do though is I'm gonna look at September 9 expiration. I'm gonna look at the 150 call. Let me delete this. I'm gonna look at the 150 call that expires in September 9. Why does it say not traded? Oh, got you. I got you now, my friend. I don't know how I did that. This is very strange, because I did right-click here on Nucor, right-click, create a rolling order, and then it opened Lennar, right? I'm confused with what just happened on my screen. I had problems today with TOS. Not sure if maybe I just didn't pay attention now and I made a mistake myself. Probably is the case. Computers on my don't make mistakes, but yeah. Anyway, so let me redo it again. The whole rationale applies, okay? 4 cents, forget about it, okay? But for sure, the way to approach it would be the following. So we would want to look at the 150 strike on Nucor. Okay, notice I selected 150 call that expires on September 9. I will want to sell one of those, collect minimum 15 cents. We've done that before, isn't it? In prior sessions, right? A long time ago. So, and I will want this to be good till cancel, but I don't want to send it today. I want to send it on Monday, because if Nucor was to rally like crazy, which is unlikely but could happen, now I may get filled on this call if I sell it now, if I send this order now, and now I am short 2 calls, which gives me unlimited risk to the upside on the trade, and I don't want to do that. So what I'm going to do is I'm going to add an activation rule, okay, a condition to submit this order only on Monday, which, by the way, Monday 5 is a holiday, right? So it's going to be Tuesday 6, okay, and we're going to do 09, let's say 35, 5 minutes after the open, something like that. This is not too relevant really, but just make sure you don't do it exactly at the open, because you may get worse prices because of the wide spreads that you may get later, okay? So 9:06, which is next Tuesday, next Monday is Labor Day, if I'm not mistaken. I know it's a holiday. I always get confused because my brain thinks in Spanish as well for the holidays, but I believe it's Labor Day, isn't it? So 9:35 is the time when 9:30 is when the market opens. 5 minutes is for liquidity to stabilize. And when I add this condition and I confirm this limit order to sell the call, so what's going to happen is that on the platform, I'm going to have a working order here waiting to get filled until that happens. Ideally, next trading day next week, okay, which is going to be the day where that 150 call that we currently have won't be there next week, because it will expire on Friday and will be gone from the account. So then when you sell that call next week, you are doing it together with the fact that you own the 150 call long that expires in October. So you are back to owning a diagonal spread with the calls. And let me rephrase that, a horizontal spread with the calls next week, okay? And now if I get 15, well, and I get 15 and I save $2 of commissions, it's like 17. So it's much better than doing it now for 4 cents minus 2 of commissions is only 2, right? So let's pretend I get filled next week. If I get filled next week on those prices, which what could happen is I don't get filled. But if I was to get filled, so what would happen is that September 2 call would become September 9, and instead of 228, I would have 228 plus 15, right? Which, to avoid mistakes, I'm just gonna bring a calculator here. 228 plus 15 is 243. So that would be the premium taken in. And if that was the case, so now the orange graph would look like that, okay? Would look like that, which basically is reducing the risk of the trade by $15. So instead of $820 of profit, of risk, now you have $805 of risk, okay? So that would be the action to be taken if you haven't rolled it yet. If you have rolled it yet, fantastic, because probably it's better than what I've got. Let me see, Joe, yeah, 0.5 is what I have tested with my zone, so I will continue to use it. My time frame is not fancy. I have to really pay attention to Jose and his details. Got it. Yeah, I'm often a little bit of a pain with the details, Joanne. So it's good to be pragmatic, okay? Now, running a process of calibration is certainly useful because you adapt the UFOs to your trading style, but there is no magic number, okay? The fact that I use 61.8, it's because it works for me. It's not because it's a magic number, okay? Now, on the put side, what do we have? We have 50 to 38 cents of premium, okay, with a theta of 61. So theta tells us we're going to make $61 a day, and we got a day and a half to expiration. So we're going to make like 90 cents. But the reality is that the only premium left is maximum 50 cents. So again, we are in front of a case where the Greeks are distorted on the put side. What's the good news? Because we are closer to the put side, so now we're going to be able to get up to 195 in exchange for paying, as little as 40 to get out. So now we are going to get decent amount of premium coming in if we roll. So that one, we're going to roll it for sure. And we're going to update that in top in just a sec. Okay, so let's go ahead and create a rolling order for the put that expires in September 2, and that will bring in $135 of credit if we get the midpoint. Let's try. Okay, let's see if we get filled. Nucor, it's okay with the liquidity, but it's indeed not the most liquid stock in the world. Okay, so I didn't know if it was going to take a while or not. It seems we got 141. Okay, so we got 141 for this order after being filled. So we just reduced the risk of the trade by $141, which is great. So back to top, and now back to the simulation, to the risk graph, I should say. It's not, well, it's a simulation, fair enough. So September 2 has been moved to September 9, and the current premium of 117 that we already collected, since the past actions, has just been increased by the amount of 141, which then brings it up to 141 plus 117. It's a total premium of 258, where if we click now when we get the new risk graph, so you're going to like it very much, because now the risk graph is basically the same as what we had before, but now we just cut the risk down to $664. Remember, this trade started a few weeks ago. We had a risk of $1,000 more or less per contract, and we are getting close to half of the risk that we started with. I mean, half of the risk is a bit exaggerated, but like 30-40% less risk than what we started with. And we still have so many weeks to go until we get to October 21st. So we are doing the right thing, and that is even without having got anything from the call side, so far. So the trade is doing what we expect it to do. We are just working on the trade throughout the time, and we will keep doing that for a few more weeks. Okay. So I'm just going to copy this, okay, because this is the management of the trade. We just covered everything that needed to be done. If you have any question about Nucor, this would be a very good time to ask. Okay. And we'll move into the next one, which is Lennar Corporation. So let me see there. Thank you, Joanne. Always so kind to me. Joe, I was pointing out why you have a zone where Jose does not. I plot my zones and they usually line up with a UFO. Yeah, well, I guess there Again, if you use different calibration settings, obviously the zones will be in different places. I guess that's the bottom line, Joe. Anyway, so linear corporation. Okay, so let's load the next race graph. Let me close the prior race graph and the option chain, and let's move to the chart. So we can understand better what happened to this particular stock. Okay, here we go. So I'm just looking at the screen and it's like, I'm just surprised because typically, I guess I didn't do it. Typically, I do a purple box, isn't it? I do a purple box, something like that. And I didn't do it. And that's why I'm looking at it and it's like, yeah, I was not expecting that. So anyway, so what's happening with this trade? Well, this trade started on that day, right here. That's where it started. Statistics suggested that from the beginning of the trade to the end, price would stay between the red lines. We had extra wiggle room thanks to our UFOs, and therefore the upper and bottom purple line was drawn and put in place. And the expectation was that from now, from that day until the expiration day, which is the end of the purple line, which is September 16, so that stock would remain in the purple box. This is what probabilities suggested on that date. Okay. Now, what happens? The very next day, okay, the very next day, that stock started moving by a lot. And the very next day, okay, we got an indication where prior to reaching the expiration date, which is that day, okay, there was a possibility for us to be trading outside the range. Okay, we could actually be trading outside the statistical range prior to this date, actually. Okay, starting on that particular date, which is, I don't know, September 12 instead of September 16. So given the massive move, the massive increase in volatility, the massive new price projection distance that was put in place given the move, so now the probability of staying in the purple zone is less. Okay, so what do we do when that happens? Okay, and instead of I answer the question, I would love you guys to answer the question on the chat box, and in the meantime, I'll read the further messaging that is happening on the chat box. But you guys go ahead and please type it in. You know, what are we supposed to do when we have a move like that that brings that stock to a condition where now we may not stay inside the range anymore? We may end up outside the range. Okay, so what would you think? Let me see. I would have been better off dollar-wise waiting until today to roll Nucor. Yeah. Mark, as we discussed in prior sessions, okay, and I totally get your comment, and fair enough, but as we discussed in prior sessions, the only way to know that ahead of time is to have a crystal ball, right? So do not feel frustrated about it, okay? Frustration may lead to triggering other trading emotions that may have you act in the market in ways that you may later on regret, right? So again, you acted based on rules. If you are not satisfied with the rules, you are certainly welcome to go ahead, do some backtesting of an alternative set of rules, come up with a new set of rules for that alternative approach to rolling, and just do that if that works better for you. But probably you will find out, and again, I say probably because, you know, I am not the most intelligent person in the world, okay? And there are many people out there trading, and millions of people are trading, and, you know, everybody has a brain, isn't it? So I'm saying that with a very, make sure you understand, with a very humble approach. But probably out of my experience and what I've seen other traders do, you will end up with the same conclusion, which is, in certain cases, that other set of rules will benefit you, but in other cases, it will not benefit you. And then maybe a set of rules similar to mine will benefit you in that other case, but in the case like today, maybe it doesn't. So what's the problem? The problem is that we cannot see the future. That's the bottom line. We cannot see the future. So it's all about acting with discipline, with a mechanical, methodical, objective approach, which imply being disciplined with your rule set. So do not fall, and I'm not saying you are, but do not fall into frustration because you see, oh, if I waited 2 more today, it was better. But yeah, that's great to know, but it doesn't help the trader because yesterday you didn't know, right? So again, make sure that this is not something impacting you too much, because we are human and we are perfectionists and we want to do a good job, and we cannot predict the future. Okay, so keep that in mind. Joanne, yes, Joe, agree. I found these calibration lines up to what I see as zone, and however the FO it cracks me sometimes. I feel like the computer. Got you. Jeff, Len call roll up on working order. Okay, Jeff, you got the call right. We need to roll the calls, but we need to roll them down. Okay, we don't want to roll them up. We want to roll them down. Okay, we want to leave the puts where they are, but roll the calls down. Why? Because if you roll the calls up, the higher the calls you select, the more out of the money they're going to be, the less premium they're going to give you. So we are now in defensive mode. In defensive mode, that stock is going down, which means the range may or may not be respected. So not a big deal. The risk of the trade is what it is, right? So the risk of the trade is $90. And I remember I got filled at a terrible price in my case. $90 is the risk, okay? Probably you got less risk, you got filled at a better price than me. But anyway, so $90 is the worst case. So per contract, we'll lose $90. Worst case, if the world is ending, we'll lose $90. Not a big deal. But since probability suggests that we are now stepping into a territory where we may get hurt, instead of we may stay inside the purple zone, now we may not stay inside the purple zone anymore. So we are now in defensive mode. And how can you become defensive? Well, you are defensive by trying to lower your risk. So instead of losing $90 per trade, you want to lose less. How can I lose less? I need to bring more credit in. How can I bring more credit in? I can only use lower calls, because calls that are lower will have higher premiums compared to calls that are higher. Therefore, we need to roll the call down instead of rolling the calls up. Okay? Yes, Jeff, and I can see your next text there. You just typed up instead of down. So perfect, no problem. You just gave me the opportunity to review it for everyone, and I guess it's a good thing to do, especially for the ones of you watching this recorded. Hopefully it helps. Wonderful. Yes, Joanne, and yeah, that's why we're here, isn't it? Okay, we're here for that purpose precisely. So very nice. Teamwork, everybody. I love it. So now, what should you have done that day? I'm going to do it today, but let's pretend for a moment it was that day, so you understand the process. Well, what you would do that day is you will look at what statistics suggest, which is statistics suggest on that day that the highest you would go is here. So notice I just got a new red line below the original upper red line. Why? Because the market went down, so now the statistical range has a lower high point, and that's what I am now projecting. So with this new lower high point, what I'm going to do is do the same thing I would always do, which is go find UFOs, right? And in this case, I got UFOs with 50% probability. I got 1, I got 2. I need minimum 2, right? I'm not going to count this one as 3 because remember, we were doing that on that day, okay, on the 26th. So that UFO didn't exist at that time yet, right? So I'm looking at the ones that are above price. And if I look at this time frame and I look above price, there are no more UFOs, right? So I need to look at other time frames. I remember last week, I had to look at multiple time frames until I found my UFOs. So I'm going to have to do the same. Okay, so 89-minute time frame, 46% probability. Actually, if I'm not mistaken, we had to go lower time frames, I believe it was. So let me do that. Okay, so we are looking, yeah, that was the UFO we're using, you see, on the 34-minute time frame. So I'm looking for some UFO somewhere here. That's what I'm looking for. What about the 21-minute time frame? Okay, is there any UFO? Yes, there is one right here. Okay, 56% probability. So what you would do now is you would get the purple line, which is above my original red line, and that purple line would be moved to where that 21-minute UFO with 56% probability is. And now if I go back to the daily time frame, so notice now that the new location for the calls will be here, 91. So instead of using 93, 94, the right action to be done on that day, you know what, let's not do it, because we're gonna use too much time and we won't have time to trade. So yeah, I was being too ambitious there. I was going to show you how to do a little bit of backtesting with historical data. Maybe we'll do that in a sharpening session one day, okay? So anyway, so instead of 94, 93, which is what I have, right? 94, 93, so you would roll it down to 92, 91, okay? And now you have options here using 92, 91, okay? So let me write it down. So from 94 long, 93 short, you would then close that and roll it down to 92 long and 91 short. And these would be premium in, which I have no idea how much because I didn't do it at the time. I would need to simulate it, and we don't have time for that today. So, but it will lower the cost of the trade, isn't it? You close this for a profit, you sell a new spread, you keep the same risk because it's same distance, same risk, but you just made a profit on the original spread and you just got more premium because of the second spread, which has the same risk as the first one you just closed. So you don't have the risk on the first one, you have the risk on the second one, which is the same one as the first one. Did I drive you crazy? Hopefully not. So anyway, so now that was that day. So now what about the next day? So the next day, same story. We are still in a situation where we are risking getting in trouble. Okay, we are risking getting in trouble. So what can you do? Same story. You will move this to the new location from here to here on the next day. Okay, now statistically speaking, we may end up lower, and you will do the same story. We're using 21-minute time frame, so let's drive there. So 21-minute time frame. Do we have the red line here? Do we have UFOs above? Yes, right there. So now you would take this purple line and you would bring it down all the way to here, okay, which is 88.5. Let's call it 89. So if this is going to be 89, what would the right action to be done now? The right action to be done now would be to take the 90 to 91 and you would sell the 89 and you would buy the 90. Okay, so in other words, you close the middle one for a profit now and you sell a new one, which again, same distance, same risk, but new premium coming in. So now that's where you are. Okay, that's where you are. So you have the put side and the call side has been rolled down 2 times already. And now what? So now the market is there, and again the next day, another push to the downside. So what do we do? Same thing. Okay, same thing on that day. And we're gonna go back to the 21-minute time frame. Okay, here's the new location for the line. Now the UFO is in the same place with the new line. That's where the UFO is, same place. So no roll on that day. We stay the same. On the next day, another push to the downside. Okay, so we are here. So back to the 21-minute time frame. Okay, it's right here. So now I'm gonna grab the purple line and I'm moving it here to where the new UFO is. Okay, back to the daily time frame, and this line is located at 85.8, so let's call it 86. So another roll we need to take place where we are doing the 87, 86. Each of these rolls produced a profit and added new credit, lowering the risk of the trade from $90 to, I have no idea, let's say maybe $40 now. So you may lose, but you're not going to lose the original $90. You would lose less, right? So that's the idea behind doing all these actions, right? And then finally, This is today. So today, one more time, we have this situation where we are here. Okay, and let's go find out. I'll start with the 55-minute time frame. We got 1, we got 2, so that's the UFO. Okay, on the 55 is what it is. On the 34, same. On the 21, same. Okay, so the last red line is here. The next red UFO is there. Okay, so same location. Okay, so I mean, I should do nothing today, but since I didn't do the prior rolls, those 3 rolls that I just mentioned, I didn't do them. So I'm gonna do the 86, 87 now, and let's see what's gonna happen. So how do I simulate the roll, and then how do I implement the roll? And as I'm about to do that, please go ahead, let me know. Jen, sorry, I mean down. You rolled to 80, 81 at 25, so you lower the cost by 25. Good job. So instead of 90, now your risk is 65 when you did that. If you did it 3 times, so you would have that nice benefit. Okay. Wonderful, wonderful, guys. Wonderful, wonderful. Love it. So how do we do the roll? Well, the way to do the roll is, I need to get rid of the call side, which are the 2 below. So I need to add 2 legs, which will simulate me getting rid of the calls I have. And I need to add 2 more legs that will simulate to sell the new calls 86, 87. So I need 4 midpoints. Okay, 4 midpoints. I need 2 buy, and I need 2 sell. So it's going to be, I was short the 93, so I need to buy back the 93. Okay, so 93, I was short at 50 cents. So 93, I buy back at whatever the market gives me. Okay, now let's do the same with the 94. With the 94, I was long, so I am selling the 94 with whatever the market gives me. So again, 94, I was long, paid 45. So 94, I am selling it, and I will get whatever the market gives me, right? So by adding these 2 legs I just mentioned, I am simulating what if I close my original 94, 93 call. Again, I didn't do this in the middle because I was not there, okay? But I am here today, so that's why I'm doing it now. So with those 2 legs, I'm simulating what happens if I close that call. And then with the bottom 2 legs, buy, sell, I am going to simulate what if I buy the 87 and I sell the 86, okay, which is that action. Buy the 87 at the current price, and sell the 86 at the current price. Okay, that's that, right? So by doing all of this long thing, that's what I'm simulating. You can just go ahead and do it directly on the platform, and that's it. But because I want you to understand what is it that we are having, or what is it that we do, I want to do it like that. Okay, so by doing that, I am going to bring 18 cents of premium. Therefore, my risk will move from $90 to $82. Okay, so I bring 18 cents in. Okay, but I keep my risk of 1. Okay, so this is not a net reduction of the risk. The total risk would be 82. There is a reduction of the risk, but also I bring more premium in. And because I bring more premium in, so now the orange line, the amount of money I could make now is more. So I am giving the trade a second chance while I am reducing the risk at the same time. And again, if you did that 3 times, so you can see you would have had that benefit 3 times. So now your risk maybe, I don't know, $60, $50, no idea, depending on the prices we had in the prior days. And the total premium now, instead of 18, maybe, $40, right? So that's the great benefit of doing that. So let me go ahead and do it on the platform. The way we do it on the platform is basically the same we did with Nucor, but instead of 1 unit, we select 2 units, the 2 calls. which we want to roll, and we create a rolling order, okay, to sell the vertical roll. Okay, now of course the platform doesn't know what we want to do, and therefore the roll is suggesting a change of date. We don't want to change date. We want to use the same September 16, and we certainly want to going ahead and doing the 86.87 that we need to change manually too. Okay, and here the only thing you have to do is you need to be careful with the plus and the minus signs. So minus, we sell 86, plus we buy 87, and then minus we sell 94, plus we buy 93. So that's correct. Okay, now if I do it like that now, it seems that I'm going to get 5 cents of credit, which is very bad. And again, why? Because the 93, 94 is probably providing plenty of slippage, and that's why. Okay, so you should have done that in prior days, and if you do it in a day like today, you have to do it very carefully. Okay, so you can get the best prices possible, because the natural price is minus 75. So the natural price, is actually a debit of $75. So the spread is very wide at this moment in time. Okay, and it's because these options are very far out of the money. They're too far. We are rolling too late. Okay, so I'm going to put the trade in, and whatever I get, when I get it, I will document it. But yeah, this is not going to be good because of what I just mentioned. Okay, but that's the process. If you do it when it's time, this process is very efficient at reducing the risk and giving the trade a second chance. Okay, but it's terrible at the moment in time. It's so far out of the money. I mean, what's the Greek for, what's the delta for the 94? It's only 12 cents. So yeah, the bid price is 0. Okay, so yeah, it's so far out of the money. No one is trading that, and bid price is 0. Okay, so that's the problem. The problem I'm encountering. If you had done that one day at a time, like I discussed, this would be a great process. Okay. Anyway, in any case, we had some homework to do today with all of this, and we got very little time for us to find a trade. But I'm really gonna try to find a trade now. If you have any question, please let me know. I'm just gonna try to be very pragmatic because we only got 8 minutes left. So I'm gonna look for implied volatility increase of CIV mean to be the greatest one. We are looking at nothing here, scan list. And let's get the penny increment options. We are looking at neutrality, daily and weekly, earnings less than 15 days, nothing, very good. So scan, let's see how many trades we get. We got a bunch. So let me see. October. I'm looking at earnings. I'm just trying to be as pragmatic as I can, guys, to save us a little bit of time, and hopefully the first trade I check, we gotta go. Netflix. Let's take a look at Netflix. Let's try to set up an Iron Condor on Netflix. Now, it's not gonna be easy at all. With this open gap above price, we won't have UFOs. Okay. Silly me. I was not thinking about that. Okay, next one. Let me see. IBM. Let's take a look. Okay, so what do we have with IBM? Earnings on 1020, so the maximum we can go is 1014. Okay, so 1014 is the maximum we can go. Let's load spread select, and let's load IBM. Good time to try one. Let's see if that's gonna work. Any question, type it in the chat box, guys. I will just do my thing just to save a little bit of time. But do not hesitate to type your questions. 1014. So maximum, we go to 1014. So we are open to look at other expiration dates before 1014. This is a $129 stock, so I'll do 1 to 2. and we are indeed willing to use filters. I'm gonna load the template for iron condors. Okay, and I'm gonna float it so we maximize the screen. And with that, I'm now gonna build 99 spreads for IBM, and we're gonna sort this and see what fails and what passes. So using September 9, we have 4 cases that pass. Let's take a look at what September 9 would bring in. From an implied volatility point of view, red line is the one located the furthest. So that's 134, 124. So 134, 124, we're 132. Yeah, no. And then from there, we move into September 23, which means that September 16 is not working. And we talked about this before. Often, the monthly expiration dates, they bring in less premium, and therefore our filter doesn't make them look good. Okay, we basically pass on those because they provide less of a return on investment. Okay, so we are now looking at September 23. A few pass. The key is to find out more about what's the statistical range on September 23, which is supposed to be 138 to 120. So we are looking at 138, 138, 138, 138, 136, 136, 136. Just a bit more premium, come on. 136, 136, 137. Just a bit more. 137, 137, 137, 137. Wow, that's a teaser. Come on, 138. No, and now we are moving in September 30. Okay. So September 30 would require 139 plus. Okay. So September 30. Almost, isn't it? Okay. So 139. So we got 138 here. $139. 139 right here. Okay, 139 right here with 119. So 119, that's it. 139, 119. That one is acceptable. So I'm gonna right click and risk graph it. And since we have limited time, I'm just gonna go with this one. Normally I would look at more, as you know, but I'm gonna go with this one. So this would provide 21 cents of spread. Okay, good. So now let's take a look at UFOs. So one September 30 is here. September 30 is here. So we are looking at the 55-minute time frame, looking for UFOs above and below those price points. No UFOs above. There are UFOs below. 2, 3. So that would be UFO number 3. So we found UFOs below 53% probability. So all of this is good. So I got the UFOs below. Let's take a look at 89-minute time frame. I need to find UFOs above too. No 89-minute time frame. Out of curiosity, why is that? Yeah, we have. Yeah, I may need to drop to a lower time frame. So 34. We need at least 2 UFOs above, plenty of UFOs, and here's one. Good, probability 55%. That is acceptable indeed. Here we go. So we have the UFO. Now, the setup seems to be adequate for me, more or less same distance between the red and the purple line above and below. So this is indeed looking good today. I won't forget the rectangle. Normally, this is what I do, isn't it? I get the rectangle somewhere here, and therefore, this purple zone is kind of like the profit zone, if you wish. And we're expecting this to be the case. Okay, so yeah, so indeed we have the UFOs and everything else. So the trade is approved; it meets our rules, and therefore I'm just going to execute this Iron Condor on IBM, and we will call it a day. And while I'll do that, I have an important question to ask you guys. How many of you purchased the book that we just launched? Just teasing, okay? But I also have a smile on my face, as you can see. We are super excited that we launched the book. First time ever for us to do it. So just sharing a little bit of the joy. So September 30, 140, 139. Okay. 140, 139. And then on the other side, we got 120, 119. Okay, so this is showing 17 cents of credit. The minimum is 15 to take it. Again, we may get more, 19, which is more than 17. But anyway, I'm just going to go with whatever it is because we have no time. And also, I never spend time negotiating prices here in the sessions to save time. Okay, here we go. I got filled on 19. Okay, so I have it. Let me document those prices for IBM. We got 41 and 32 for the call. Okay, so 41 and 32 for the call. And for the put side, we got 85 and 75. Here we go, and that would provide a credit of 19 cents, which is what I got right there. Okay, so this is now in. I'm just going to add this to our list right here. That's it. We have our IBM Iron Condor. I'm going to close this, and then the last thing for me to do before we say goodbye is to have a couple of lines, one vertical, so we know the day we entered, and one horizontal, so we know the price, where the market was, where the day we entered. And I'm just going to save this as options with options. So that way, all is good. Wonderful. Perfect. Very good. Joe, I did. Mark, I bought it. I did it. You guys are the best. You guys are the best. Thank you so much for the support, my friends. Yes, you are correct, Joan. We identified and we reported to Amazon a problem with some Amazon stores, even actually in other countries than US is happening too. But anyway, you could find it in places other than Amazon. Okay, you can just use Kobo, ebooks.com, you name it, Barnes and Noble. It's everywhere in electronic or paperback format. So you can get it anywhere. So you can try that if you don't want to wait. And if you want to wait, I guess at some point Amazon will fix the issue. For whatever reason, there are certain places where it's kind of like the book has not been pushed properly into the Amazon store. And we've been told by other people as well the same thing, Joanne. So I'm sorry about that, but anyway, very kind of you guys to support, spread the word, because not that I like to talk about the price of things. I think it's not a very elegant conversation to have, but I'll do it if you don't mind. $3.88 for the Kindle version of the book, and it gives you access to a FOREX course and 3 months of UFOs for your friends and family members who want to learn how to trade but never traded before, and they can read a book and get a course and get technology, and that's $3.88. So I guess it's a pretty good value for them. So we're really trying to help people. There are many people out there that need to learn how to do this, so many people get in trouble, and We truly believe in what we do, and without sounding arrogant, I will say I think we know our stuff. So we truly believe that the book and what we do can really help, and we are just trying to make it accessible for everyone. So share the word, share the love, and thank you for the support, guys. And again, thank you for sharing our joy and excitement as well, because first time for us as a company to launch a book. So it's really exciting times. Anyway, everybody, you guys take care. I will see you soon, and keep up the good work. A pleasure working with you guys, and again, very proud of how everything is progressing. So keep up the good work. Take care, everybody. Bye-bye.